Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, Financial Enhancement Group. Also have Andrew Thrasher, a Chartered Market Technician and Portfolio Manager here with us as per usual. And Andrew, we don't have much going on this week. Kind of a boring, quiet week, you know?
It was nice with the markets closed on Monday. We record these on Tuesday. So when the markets closed yesterday, it was kind of nice to have a day to play catch up. And now things are back rocking and rolling and all kinds of headlines and a lot for us to discuss today.
Yeah, absolutely. So, of course, I was pointing to a pretty packed agenda. So we'll dive right in. And we've got a couple of points on interest rates. One that surprised us. So I'm banking on the fact that the majority of you will kind of be shocked by what the markets are looking at going forward. So we're going to talk about interest rate cuts, the way the market and forecasters have viewed higher interest rates in the past, the daily chart for the S&P 500, which we've had a lot of weeks in here just for how important it's been, particularly in the past 6 months. Look at activity for retail investors. Oftentimes they can give you an opportunity to zig when they zag or vice versa. High yield spreads, and then an update to our risk barometer. So in some cases here, we kind of buried the lead, given how important the risk barometer is to our process. So I want to dive in and look at interest rates and the way the market is pricing in interest rate activity. So the black line on this chart is how the futures market is pricing in and how they believe the Federal Reserve will act, which of course, most of us now are on the same page, and the market fully understands that there should be a number of rate hikes. So therefore, the black line, the Fed futures 12-month yield, so the rate, the interest rate that the Federal Reserve sets for short-term interest rates is expected to go up quite a bit as we go on through this year and through next. The big surprise is that red line. The euro dollar, that's a fancy term that's been around for a long time. That is simply a term for interest rate futures because they first started trading over in London and played their role and get started over there. But essentially, it's just the way of the market pricing in where they expect interest rates to be in the future. And that red line shows you the expected change in 2024. So for a number of months over the past year, not a whole lot could be said about 2024. What in the world could we make out for a few years out there? But we've seen a very noticeable shift here as of late, particularly as we go into February, as that has shifted negative. That's telling us that the market now believes that we will see Fed rate cuts in 2024. So all this talk just of how much they will raise rates now and into next year, they're already looking for the following year, 2024, for a rate cut. So a lot has to be taking place between now and then. But it's certainly the stage is set, and this corroborates other bond market activity, which says that they will move too aggressively. They believe that the Fed will raise rates, and all that will act to slow down activity enough to where they'll have to cut. And some would call that a policy error. Some would say they have no choice. We'll see. But a big change in market dynamics. Andrew, anything you want to add into futures bets there on the Federal Reserve?
The way I kind of read into that a little bit is just the market has an expectation, I think, that we're not going to see a lot of strong economic growth. Why would the Fed be cutting interest rates? Part of the reason for that would be to help stimulate growth. The same reason why they're expecting to now raise interest rates to keep from growth getting too hot. They would start lowering rates to try to kind of stoke the fire a little bit. So I think this is kind of the market's way of saying that the Fed will overreact and tighten too much, like they often will do, and that we're going to see maybe a pullback in economic growth, and that's going to require them to then start lowering rates once again. Like you said, this is 2024. A lot can happen between now and then. There's still expectations of what's going to happen this year, much less 2024. But it is very interesting that they're already pricing in basically a full cycle of interest rate changes already.
Yeah, it certainly lines up with history. I mean, we build in a sort of an institutional knowledge. It happens every cycle that the Fed goes too far. So this is just basically in one way saying, in my view, that the market's saying we'll see again what we have always seen, that they go too far too fast, and that's what causes future slowdowns. Sticking with interest rate increases and taking a look at a step back, and this one just kind of floored me. It is messy. When I showed it to Andrew, he asked if had a young child draw with crayons on it. And the answer is no. It's actually pretty simple what's going on here. The black line is the 10-year U.S. Treasury rate. And you go back to 1992, there have been some cases of rates going up. Noticeably, 1994 was a big, interesting year for the bond market. But the big thing is that for over this time frame, we have seen interest rates fall and fall and fall and fall. The orange line are professional forecasters. These are measured by the Philadelphia Federal Reserve. They've collected this data for a long time so that they have an accurate track record for what economists believe. And you can see as interest rates are falling, 24 out of the last 26 years, that forecasters have consistently called for interest rates to go higher, particularly as we get into the past 10 years. And that makes some sense if you think about we've gone from 2 to 1 to 0. That was so much lower than most anybody had lived through. You think they've got nowhere to go. They've got to go higher. And time and again, they have proved out to be wrong. And the reason that's important is to really kind of resettle and humble ourselves. We hear our investment plan and strategy the last couple of years. We don't invest based on our forecast, but our outlook certainly was pretty convinced for higher rates. But we never want to get married into that forecast and be respectful for the fact that because they're low does not mean that they have to go higher. There is a long multi-year, multi-decade trend of rates going lower. So, and if I say we don't use forecast here, Andrew would take it to the next level. So I'll let you add in anything you want to, Andrew.
I think economic forecasters, the whole profession was created to give weathermen a good name. I think this chart proves that. The idea that we couldn't have, that no one ever expected us to have negative real rates, see them across the globe. No one ever forecast that we would see oil prices go negative. Saw it happen in 2022. The fact that economists have been getting rates wrong for 20, 30 plus years, I think kind of fits the bill for them. This is why we focus on what the market's telling us versus trying to make some multi-year guess is really all it is. But weathermen sure look better when you plot that chart out there, don't they?
They sure as heck do. And there are implications for all of you watching. In our investment plans, we've been very defensive in our bond allocation. In fact, more defensive than I can remember being, protecting against higher rates. But why that's so meaningful to me, at least, is that we're warm-blooded mammals, and we feel more comfortable in crowds. And so we can get ourselves positioned, and we did. And we got a lot of company for people thinking rates are going higher. So then we have to retrain ourselves that it's okay to break away from the herd, which we recently did and actually bought some treasuries just because of how many people begin to forecast rates. We sometimes have to get out of that herd if we want to get ahead in financial markets. So now we're going to move and update ourselves on the technical side of things, a very important place right now for markets that have gone sideways. Andrew, you've covered this week in, week out. Where do we stand now on the daily chart for the S&P 500?
Yeah, so this is a chart that's real familiar to our advisors or anyone that attends our allocation meeting. It's one of the first charts that I'll show because I think it's important to recognize while the market may not have done a lot over the prior week, to kind of take a look and say, okay, where are we in the price action of the S&P 500? And in the shortest version, the market's gone nowhere for a very long time. We're basically at the same place we were in August of last year. We saw some steady minor new highs that constantly were given back, and now they've really started to give them back at the start of 2022. Right now, we're seeing continue to kind of a risk-off mode this week as we record this again on Tuesday. Markets are down today, kind of testing back to those 4,300 level area. The prior lows from January. So the market, the price construction doesn't look great here. We're going to start talking about the risk barometer later. We're seeing a lot more downtrends than uptrends, unfortunately. That is part of a longer term cycle. Markets don't always move in a straight line up, and they don't move in a straight line down. But right now, the price action is less encouraging than it was in 2021.
Yeah, put it clearly, our job is to play the hand that we're dealt, and right now it's not a pretty one. We may log on here next week and have a better one, and we'll adjust accordingly. But for right now, that's the hand we're being dealt, which begs the question. We do pay attention to what happens in the retail investor, so I want to turn it right back to you as we look over what the activity has been at the retail investor level.
Yeah, so when we look at the different investing groups, we kind of can split everything up into either retail, kind of the average consumer buying in their personal accounts, and then you have institutional investors. Now, the main drivers of markets are institutional investors, and that's purely just because of the size. When an institutional investor can deploy tens of millions, hundreds of millions of dollars in a single day into a position, that's going to move that stock. And so we often are trying to track what those large institutions are doing, and we have ways and data sets to do that. But we also don't want to forget about what the retail investor is doing. We want to get kind of the sentiment, check the temperature of the retail market. And what they've been doing lately has really been buying the dip. Every time the market goes down, they've been trying to put more cash to work. And that's a theme that worked pretty well over the last 2 years. Every time the market had a minor pullback, they were able to put more money in the market, and it came back higher. That strategy isn't working real well in a lot of places in 2022. So we can see kind of where retail investors are going. It's still a lot of those mega cap tech names. And I think what's interesting on this chart, we can see the panel on the far left shows they're buying stocks like NVIDIA, Amazon, Tesla. And if we look at that last column, the stock return, you can see they're not being rewarded for that activity. The stocks are down 19, 12, 14% and on. And so where retail investors are putting a lot of focus is really the technology space. Really the net flows into tech since 2019 has been about $40 billion. Compare that to the second highest is at $15 billion for consumer discretionary. So this shows how heavily invested a lot of retail investors are right now in the tech space. And tech has really been kind of taking a punch on the chin here lately. But they're continuing to go back to that area. And so the takeaway for us as money managers is the sentiment from the retail crowd is still fairly bullish. They're not panic selling yet. Typically what you'd see at kind of a more major market low to where they just say, I've taken enough pain and start selling. That's the kind of activity we want to see, that kind of blood in the streets mentality where everyone thinks nothing can get worse and then things start to bottom out. So sentiment is yet to really hit those painful thresholds as retail investors are continuing to still come into this market. So we want to actively watch that and see when does retail kind of give up. And maybe that will be the break in the dark cloud, so to speak, to where maybe we can start seeing more constructive price activity in U.S. equities.
Yeah, it's kind of mind-boggling, honestly, with some of the devastation that we've seen. But the activity is the activity. For whatever reason, they're breaking from traditional cycles. But our response has got to be the same. And for whatever reason, we're not seeing that kind of everybody throwing their hands up and wondering what to do next just yet.
Right.
And another thing we really pay a lot of attention to, and those of you that watch the market Carver for 10, 15 years, know that we bring this out a lot, particularly when we want to seek guidance on next layers. This is certainly a piece of our risk barometer, and that is the high yield market. And this is when we say high yield market, we are looking at bonds, and particularly the bonds of riskier type companies that have a higher probability of going bankrupt. How investors are pricing these bonds and how liberally they are lending them money and the types of interest rates they're requiring of them means a lot for what the future direct implications are going to be. Before I have Andrew unpack the chart and give us an update on where we are, just a couple cents on why this is important. It's not always the case we're interested in why, but in this case, it certainly is, because in the bond market, I believe there are more direct implications. Whereas in the stock market, people can have a very, very long-term mindset. Companies don't really have to redeem their stock. But in the bond market, you have interest costs and you have to replay these bonds. You have to find new funding all the time. And so where the market has you currently has a real direct impact on companies. And so why this is very important is as we see yields and interest rates go higher, it becomes it's almost a self-fulfilling prophecy. When these interest rates go up, the risk is that companies then in turn have a harder time being able to fund their debt, and therefore in turn, ironically, become more likely to default. And so they can often spike very aggressively, and something we have to watch out for. So with that behind us, why it's so important, where are we at today?
Yeah, so looking at this chart, we have the S&P 500 on the top panel. The middle, we have the high yield spread, and the very bottom, we have the AAA, kind of the high, the investment grade bonds, those higher quality bonds. What the spread is telling us is the difference that investors are requiring in coupons and interest for owning those higher yield bonds or the underlying bonds versus owning something maybe like Treasury, something that's guaranteed by the government. When the markets get a little bit more nervous, they start requiring higher payment. So that spread starts to widen. The reason we watch this, as Adam just said, is also when the market starts to go down in the equity market, we want to see is the fixed income market also showing a little bit of concern. Initially in January, they weren't. We weren't seeing these spreads start to rise, suggesting maybe the worry, the panic is only happening in equities, which would be a good sign that fixed income markets are still pretty confident. That's begun to change a little bit here now. Now we're starting to see high yield and actually in high quality investment grade bonds, the spreads are starting to widen. They're making higher highs, suggesting that investors are requiring a higher payment to own that debt relative to something like a treasury bond. And so now that we're starting to see a little bit more concern come into fixed income, it suggests that the downturn we're seeing in equities maybe could be a little bit more persistent than maybe what we originally thought in January, as fixed income can sometimes be the tail that wags the dog because it's massive compared to the equity market. And so when fixed income traders get worried, then we really want to be cognizant and watching the markets at that time. So we're still not quite at major spread levels. We compare these to other times in history, but they are starting to widen. So we want to be key focused on that and see if we continue to see these lines move higher while equities move lower. Ideally, we start seeing that reverse, where these spreads start to contract as fixed income traders become a little bit more confident, a little bit more bullish, and then maybe the equity market would respond in kind. But until then, we're still a little bit cautious at this point.
Yeah, so when we put this all together, our risk barometer is one of our primary risk tools. So I want to give you an update on that as we look at high yield spreads, we look at trends, and take a look at where we are now. As Andrew highlighted, we have, for the most part, gone sideways in the S&P 500 or nowhere really since September in the fall. But that dynamic is beginning to change. And the risk barometer is, as Andrew hit a couple weeks ago, it's completely unemotional. It is observation-based. It's on a variety. It's information in different categories. We have not only trends and technicals of the market, but we also have fundamentals and valuation, as well as some economic trends. So we put all those unemotionally into a system that guide us on whether we want to be offensive, defensive, or neutral. From an allocation standpoint, I would note that even though we have been on offense, that doesn't mean that we have to put on our, using football analogy here, we don't have to put on our really aggressive four-wide receiver throwing Hail Marys all the time. We've had a pretty conservative offense just because we hadn't seen a lot of positive breakouts on charts. We've seen the progress be constrained to pretty small areas in the market. So we hadn't really had a real aggressive positioning in the market. But this turn now has got us on defense, which means it certainly does mean some changes, not in every model. That's an important to note. We do treat the 8 different models a little bit differently. Or if you're in all bonds, for instance, it's not going to mean anything for that category because it's an equity management risk tool. But that red dot there on the far right is the recent observation. You can see we begin to break lower, and the red indicates defense, which means that you're likely to see a little bit more defensive activity, a little bit more cash, a little bit more conservative type investments in the portfolio. And who knows, the way we built this, it could flip back in a week or two, and that's what we ultimately hope for. And oftentimes that can mean we miss out on some upside and some rebounds. That's fine. This tool was built to be a risk manager and keep our drawdowns reasonable and tolerable for the model that you're in. Andrew, what would you like to add as we move here to defense?
Yeah, so Grant and I had a great conversation. It ended up being very timely because we were talking just about this very thing. So if you missed that market Carver, that was 2 weeks ago. Was it 2 weeks ago or was it last week? Oh, it happened so fast. I believe it was 2 weeks ago. But we can always send that to you. Just reply back to the email from this market Carver. We had a good conversation talking about the trend component that had moved negative, and that's what sent here kind of the last straw to move the risk barometer to defense. But as Adam said, that it's very data dependent. I did an interview yesterday on Fox Business, and they asked, how are you changing your investment bias based off what's going on in Russia and Ukraine? I said, we're not. We're dependent on the price action. We're dependent on the data we have in front of us. And thankfully, we don't have to be war generals. We didn't go to West Point. We don't need to know the psychology of what Putin's going to do next. We can be focused on what our key area of expertise is, and that's managing investment portfolios, not trying to manage headlines or what chess game they're trying to play out in Europe and through Russia and Ukraine. So we are dependent on what the market's trying to tell us. We don't have to try to be 2 steps ahead of whatever's going on in Russia. So while that is important and that can have implications to different parts of the economy and of the market, like energy and some of the metals and things like that, we're very much focused on the market side of it and less so on the headlines that come out every day.
Yeah, very, very well said. And, this is now Mark's over 20 years and counting, and professionally, let alone on the academic side. And nothing but pain has come from worrisome headlines. There's always going to be fear-based opportunity, and it's always going to present itself as a selling opportunity when you have negative dark clouds from the headlines. But the market is so irrational that it just renders those useless. The market is forward-looking. Maybe we're going sideways and down because of these concerns. We don't really know. But what we do know is that we will follow that risk barometer and let it guide us. And as it has in the past, for when it's time to get back in. For instance, you go back to 2020, right? COVID was the last really major negative headline, and we relied on it to get us out. And we relied on it to tell us, I believe it was sometime in May. It's not going to be the absolute bottom, the perfect time, but it does tell us when we see enough conditions to put more chips back on the table. And that's what we'll do this time. So thank you. This was a little bit longer, but a very important one. So I wanted to clear up these items and cover them all. And unless Andrew has anything to add here, don't forget that you have the opportunity to schedule a meeting with us, 800-928-4001, or scan the QR code. And then don't forget, you have a radio show weekly that you can have an opportunity to listen to over the airwaves on IBC, Consider This, or Shine 99, or some of the other stations around the state, or however you get your podcast. So thanks again, and everyone have a great weekend.